14 quarters in a row Berkshire sold. Last quarter it bought. If you own Berkshire, that's your money. And the rule that guided it for 3.5 years just flipped. Not slowly, in 90 days. In the 3 months to June, Berkshire bought $19.8 billion more stock than it sold. That's $60 from every person in America in 1 quarter. Here's the part the headline skipped. That money barely spread out at all. Nearly every dollar of it went into one company. And only one brand new name turned up in the entire book. It's worth $580,000. A rounding error. This is one bet, and it's all on paper. 5 investing methods score this move tonight. One says 8, one says 4. You get the board's number at the end, and the single thing that would flip it. Watch the 4th chair. First, what Berkshire actually is. Most people think it's a fund that buys shares, the way you might own a slice of the whole market through your pension. It isn't. Warren Buffett built a company that owns other companies outright. The head office is one rented floor in Omaha, beige walls, a water cooler. A few dozen people run the whole thing from there. Once a quarter, big investors have to show what they own. The form is called a 13F. It lists every share position on the last day of the quarter. Berkshire filed its one on the 14th of August, signed by a vice president called Mark Hamburg, covering the quarter that ended in June. That paper and the quarterly accounts are what tonight is built on. Every figure comes off them. Start with what it owns outright. A railroad. Mile-long freight trains crossing the American West every single day carrying grain and containers and coal. It owns power lines and wind farms across half a continent. It owns a candy maker, an ice cream chain, and a forge that stamps parts for jet engines. And it owns a car insurer. That's the engine. People pay Berkshire now for claims it might pay years later. Warren Buffett called that gap the float. It's a giant pile of other people's money, and Berkshire invests it while it waits. That's the whole trick. That's how an insurer became one of the biggest share owners alive. On top of the companies it owns, Berkshire holds shares in companies it doesn't. That pile is worth about $299 billion. And it's not spread thin. Berkshire says its 5 biggest positions are 66% of that pile, 2/3 in 5 names. Look at what didn't move. Apple, the same 227 million shares. Coca-Cola, the same 400 million. American Express, untouched. Chevron, untouched. Now the streak. Go back to the end of 2022. Every single quarter after that, Berkshire sold more shares than it bought. 14 quarters, 3.5 years. That isn't a mood, it's a position. When the most watched investor alive spends 3.5 years selling into a rising market, quarter after quarter, without ever explaining himself, he's telling you exactly what he thinks things cost. So where did all that money go quarter after quarter while Buffett kept selling? Somewhere very dull. And that dull answer is the reason this quarter matters at all. Berkshire parked it in Treasury bills. Those are short loans to the American government, the safest, dullest thing you can buy with money. That pile now sits at about $325 billion. Written down is just a number, so hold it against the share pile. The safe pile is bigger than the entire share pile. Berkshire holds more in government paper than in every stock it owns put together. Remember that. It comes back at the end. You can read that 2 ways. A fortress that can't break, or a man who thinks everything is too expensive. For 3.5 years, both readings said the same thing. Wait! Which brings us to Greg Abel. He ran Berkshire's energy business for years, and he built it from one Iowa utility into wind farms and wires across half a continent. He did it with concrete, steel, and permits. Turbine by turbine, substation by substation for 20 years. That's a slow way to build a career. Now he's president and chief executive. His name signs the quarterly accounts. This is the first full quarter of buying with his name on the paper. One honest note before we go further, because I would rather you trust the rest of this, Berkshire has never said who picks which share. The share filing is signed by a vice president called Mark Hamburg. The accounts are signed by the finance chief. Nowhere does any document say Abel bought anything. So when I say Abel bought, I mean the company he runs bought. In the first full quarter he ran it. That's the fair way to put it, and it's how the board will judge it. So what did $19.8 billion buy? Here's the shape of it. Almost nothing new and almost everything into one name. Alphabet, the company behind Google. Berkshire nearly doubled it, adding about 48 million shares in 3 months. At the end of March, that stake was worth about $16.5 billion. By the end of June, about $37.8 billion. It's now the 3rd biggest thing Berkshire owns. Alphabet now sits above Coca-Cola in this book. Coca-Cola, the position Buffett opened in 1988 and has never once streamed in the 38 years since. A search company jumped it in 90 days. Now the other side of the page, Berkshire sold banks, Bank of America down 30 million shares, Capital One cut by more than half, Ally trimmed again. It sold Kroger, the grocery chain, down 22%. It sold Nucor, the steel maker, down more than half. And it sold out of Constellation Brands completely. A stake worth $95 million in March, zero in June. That position no longer exists. So read the trade. Out of banks, out of groceries, out of steel, into one search company. Whoever sat in that Omaha office and signed those tickets wasn't spreading risk around to be safe. They were picking. There's one more thread and almost nobody's pulling it. Stop looking at the big names and look at the small ones. Berkshire raised Leonard, the home builder, by 30%. It opened a stake in D.R. Horton, another home builder. It already owned NVR, a third, and Louisiana Pacific, which makes the siding on those houses. 4 names, 1 industry. American housing. Nobody buys 4 housing names in the same 90 days by accident. And the Horton stake is tiny, $580,000. Less than a house on that street. But nobody at Berkshire opens a door they never plan to walk through. And Abel has spent 20 years building things that take a decade to pay. 2 more ads worth naming. Macy's, the department store everybody keeps writing obituaries for, more than doubled. And Delta, up 44%. Berkshire swore off airlines in 2020 and said so out loud. Somebody there changed their mind. That's the book. Every single figure I've given you sits on the share filing or in the quarterly accounts, and both are linked below so you can check me. Now the board. 5 methods take the chair. Not the men, the methods, exactly as they publish them. Each one scores this quarter 0 to 10, names the single number behind the score, and says what would change it. Chair 1, Benjamin Graham. He wrote the book Value Investing came out of. His method starts with what a company owns and owes, and asks one question. If everything goes wrong, what's left?
An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return.
Run Berkshire through that and it's almost unfair. $325 billion in government paper. The cash covers the whole share pile and then some. Nothing on this page can break this company. No margin call. No funding squeeze. Graham's first test isn't beaten here. It's buried. His number is that safe pile. His score is an 8. What would flip him? The pile shrinking while profits stay flat? Then it stops being a cushion and starts being spending. Remember that. The 4th chair reads it the opposite way. Chair 2. Peter Lynch. He ran the best fund of his generation on one rule. Buy what you can explain. If you can't say why you own it in 2 minutes, you're guessing.
Never invest in any idea you can't illustrate with a crayon.
Now try that here. A railroad, a power grid, an insurer, 26 listed companies, a search giant, 4 house builders, a store, and an airline, all in 90 days. Draw that with a crayon. And there's the size problem. Move 19 billion and you barely move a company this big. His number is 26. His score is a 5. What would flip him? One buy you can explain in a sentence. Chair 3, Philip Fisher. He barely looked at the numbers. He asked people, suppliers, rivals, former staff. He wanted to know if the people running the place were any good.
I have stressed management, but even so, I haven't stressed it enough. It is the most important ingredient.
So Fisher's question isn't what Berkshire bought, it's who bought it. And Abel has a 20-year record you can walk around and touch. Wine farms, substations, wires. His number is 14, the quarters of patience before he moved at all. His score is an 8. What would flip him? 3 more quarters at this pace. That's an itch, not conviction. Chair 4, this is the one. Howard Marks built a career on second-level thinking. Everyone reads the headline. He asked what the headline is still worth once everyone has read it.
I don't believe in forecasts. We never know where we're going, but we sure as hell ought to know where we are.
So where are we? Do the arithmetic that nobody in the news cycle did. Berkshire spent about $19.8 billion. It's sitting on about $325 billion. 6%, 6. That's what changed hands. 94% of the cash is sitting exactly where the caution put it. 6% isn't a change of mind, it's a toe in the water. After 3.5 years of waiting, the wall of Treasury bills is very slightly shorter than it was, and Marx would tell you that's the whole story. His number is 6%, his score is a 4, the same fortress Graham called a cushion, Marx calls an unspent opinion. What would flip him? One $50 billion purchase. 1. Then the cash pile is a decision instead of a mood. Chair 5, and this one breaks the tie, Stanley Druckenmiller. He thinks spreading your money thin is how you guarantee an average life. When he's sure, he goes big and watches it like a hawk.
If you really see it, put all your eggs in one basket and then watch the basket very carefully.
By that test, the shape is right. Berkshire didn't buy 30 things. It bought one thing hard and left the rest alone. 16.5 billion to 37.8 in 90 days. But the size is wrong for the conviction. If you really see it, you don't stop at third place. His score is a 6. What would flip him? Alphabet becoming a top 2 position. So there's the board. Graham 8, Lynch 5, Fisher 8, Marks 4, Druckenmiller 6. That's a 6.2, with 4 points between the highest and the lowest. The widest split this board has had all year. They agree on one thing. Nothing here can break. One ask, and it's the only one you'll get. We're a brand new channel. Subscribing is how we know you want more of this. That's it. Back to the split. What splits them is one question. Is 1/4 of buying a turn or a nibble? Fisher and Graham see a careful operator moving. Marks and Lynch see 6% and a lot of noise. My number isn't the 19 billion, it's 4. 4 housing names, bought or raised in the same quarter. One of them for the price of a small flat. A company this size doesn't buy that to make money on it. It does that to open a door. So watch what walks through it. If that tiny stake becomes a real one in 3 months, the housing thread was the story and Alphabet was the headline. You can run this board yourself on any company with 3 inputs. 1. The safe pile against the share pile. 2. The size of the biggest buy against the cash. 3. Whether you can explain the trade in one sentence. These are the numbers the board saw in June 2026. The methods are timeless. Run them again with next quarter's numbers and see what moves. At these prices, on this filing, the method says 6.2. A fortress that finally spent something and a board that can't agree whether that's courage or restlessness. Next quarter settles it. If the buying carries on, Fisher was right. If the cash pile climbs back, Marks was. One filing, 3 months out, and one of those chairs is wrong. These are models of published methods, not the people. Nothing here is financial advice. The board sits again next week.